Good morning. Multifamily investors say it's go time. Multifamily investors are shifting decisively from caution to action as 2026 begins. And after several years defined by rate volatility, frozen transaction value, and wait and see underwriting, momentum is building across the apartment sector. And according to insights shared by Marcus and Millichap, the National Multifamily Housing Council Conference, or NMHC, investor sentiment has turned from defensive to opportunistic. This isn't speculative optimism, it's capital that's ready to move. So let's talk about capital that's ready to deploy. And as institutional investors, large private equity funds and family office-backed groups are reporting significant dry powder that's been earmarked specifically for multifamily acquisitions in 2026. Now, unlike recent years when buyers targeted one cautious transaction, many investors now plan to complete multiple acquisitions this year. And notably, the groups stepping forward are experienced operators with strong balance sheets and proven execution capabilities. Now, while smaller syndicators were less visible at NMHC, the investors who are active today tend to be disciplined, well capitalized, and well prepared to act quickly as pricing resets. So fundamentals are uneven, but they're improving. And investors remain realistic about near-term challenges. Job growth is moderated, and elevated apartment supply, particularly in Sunbelt markets, will create uneven performance throughout 2026. Now, however, most investors believe that these pressures are temporary. And as new deliveries are absorbed and construction pipelines thin out, fundamentals are expected to stabilize. So markets with strong population growth, diversified employment, and affordability advantages, including Texas metros, particularly Houston, remain long-term favorites for multifamily capital. So debt markets, they're reopening. And one of the biggest shifts supporting renewed transaction volume is improving access to debt. And agency lenders have meaningfully increased allocations, with Fannie Mae and Freddie Mac stepping back into the market. And at the same time, banks and alternative lenders are selectively re-engaging, providing more financing options than investors have seen in recent years as well. While interest rate uncertainty hasn't disappeared, capital availability has definitely improved. So for well-structured deals with realistic leverage and strong sponsorship, financing is no longer the bottleneck it once was in 23 and 24. So the thought is that distress is moving from theory into reality. And perhaps the most important catalyst for activity in 2026 is the anticipated return of distressed and reset basis assets. And lenders are gradually moving away from extend and pretend strategies, signaling that low maturities, recapitalizations, and note sales will likely increasingly come back to market. Now, for disciplined buyers, this environment creates opportunity. And assets acquired at a reset basis, combined with stabilized financing, can offer attractive risk-adjusted returns as fundamentals normalize over the next cycle. So why 2026 matters? Well, multifamily is not entering a speculative boom, but it's entering a transactional reset, and capital is available, and pricing expectations are adjusting. Debt markets are functioning, and motivated sellers are emerging and raising their hands. Now, for investors who stayed patient and preserved liquidity, 2026 may represent the best multifamily buying window since the last rate cycle turned. Now, if you're evaluating acquisitions, recapitalizations, or just financing strategies, this year is the key. The key to this year is preparation. So understanding capital stacks, debt yield, realistic rent growth, and long-term market fundamentals are your key concepts. That is it for the day. Love to talk to you more about your situation. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. Love to talk more.